हेलो साथीहरु नमस्ते वेलकम अल अफ यु टु माई च्यानल। आजको डिस्कसनमा हामी चाहिँ लिभरेज र ब्रेक इभन एनालाइसिससँग रिलेटेड एउटा इट्स क्रिटिकल क्वेसन डिस्कस गर्नेछौँ विच द्याट यु निड टु क्लियरिफाई द अल आस्पेक्ट अफ इभन द अकाउन्टिङ एन्ड द फाइनेन्स आई वुड से। र एज पर दिस क्वेसन्स के छ भने दस यु आर गिभन सेलिङ प्राइस पर युनिट द्याट इज द in $100 and fixed cost is 2 lakh while number of units produced and sold in a year which is noted by Q here that is 5,000 and company's operating profit is $50,000 and company's asset all equity finance भनेको मतलब we don't have the any debt sources. Now it can change the production process with additional investment in like your assets is the additional investment of 4 lakh and the fixed operating cost is 50,000. That means previously it was fixed cost 2 lakh, now it will be 2 lakh 50,000 when the company change the production process, and this change will cause reduction in the variable cost by 10 and increase the output by 2,000 while selling price per unit reduced by $5 that is the 95 and cost of capital is 10% that is the 0.1. Now the question is about should company make the change its production process or not, if so how. Now what would be the degree of leverage, operating leverage, it will increase or decrease if it made the change, and what about the its break even point friends. Okay, now at first, once you organize your given information by reading the question carefully, then you could proceed towards your solution part. For this question, at first you need to find the variable cost per unit as we don't have. So we know that earning before interest and tax is simply Q P minus V minus fixed cost, that is sales revenue minus variable cost minus fixed cost. So put the value of EBIT which is given $50,000 and Q is given 5,000. Selling price per unit which is noted by P is the 100. We don't have B, and while the very fixed cost is 2 lakh. Now once you solve this question, then this will be now 50,000 plus 2 lakh equals to 5,000 100 minus V. Now once you solve for V, here V would be simply, you can say that 2,50,000 divided by 5,000, that will be the 50. So your V would be now simply 100 minus 50, I mean to say that. Okay, that is your variable cost per unit is $50. Actually you are going to take decision whether it would be good to change the production process or not. Then as a financial analyst, you are going to you find the expected, you can say that expected change in return on assets, that is change in EBIT divided by change in assets. Okay, so new EBIT you need to find here. New EBIT means your Q is 7,000 and your V would be now P is 95. Okay, I'm just typing the 95 and the variable cost P minus V would be 10 reduction in the $10. Okay, minus now total fixed cost would be 2,50,000. Once the company change the production process, then in this case you would have a new EBIT is 1,35,000. So at first find the your change in EBIT. Change in EBIT is simply this minus your existing EBIT. Existing EBIT is this one. This is given 50,000. So your change is 85,000. Therefore you can say that your expected change in return on asset is simply change in EBIT. Okay, use the equal sign here. EBIT change divided by this into 100 because I need in percentage value. Okay, that is the I need change in assets. Now what about the change in assets? yeah, this value is missing here. Company need to invest additional is the 4 lakh. That is why you would have a change in asset would be how much here is the 9 lakh minus is the, look at your company's asset is the previous one is the 5 lakh. Okay, this is your 8 lakh. This is 5 lakh. Okay, so you would have a 4 lakh is your additional assets value. Now this way you could find the your return, expected return on assets. This is simply change in EBIT as I discussed earlier divided by this value into 100. Okay, so that is why we can say that 21.25% here is our return on assets. Now you need to compare this rate with the cost of capital here. Here cost of capital is 10%. That is why you can say that since your return on asset is greater than that of cost of capital, it would be good to change the production process to maximize the company's profitability. Okay, now next one is that let's move to the next questions. What about the degree of operating leverage? Degree of operating leverage for each case you need to find here, that is the contribution margin divided by EBIT, that is. Okay, now contribution margin is simply you can find like this. This is Q, existing case 5000 into 100 minus 50. This is our contribution margin. Okay, use our equal sign here. Okay, that is the 2,50,000. Now what about the EBIT that is given? EBIT already there 50,000, and that is why in this case you would have a degree of operating leverage is simply you can say that contribution margin divided by 50,000. So this is the 5 times. It shows that 1% increases in sales causes 5% changes in company's EBIT. Okay, this way you could analyze your result. Now similarly for contribution margin for new case, simply here you can use the 7,000 into 95 minus 40, and this way it will be 3,85,000. While new EBIT is 1,35,000, you already calculated, even though you could find it 7,000, 95 minus 40 minus 2,50,000. And that is why in this case you would have a simply 2.86 approximately, you can say that degree of operating leverage. It shows that again 1% increases in sales causes 2.86 percentage changes in company's EBIT. Now last question is that what about the break-even point? Break-even point is that simply you could find the break-even point for 2 cases again. For one is the existing, for existing case it will be fixed cost, we have 2 lakh. Okay, that is the 2 lakh is there divided by P minus V, 100 minus 50. So that is the 4,000 units. When you multiply with the selling price per unit, that will provide you break-even point in rupees. Okay, I hope you understand the process. Okay, this is the units. Okay, units. Okay, now for new case you can say that what about our break-even point again? Fixed cost, now this is 2,50,000. You have to just change the figure. Now this 95 minus 40. Okay, this will be 4,446 approximately is the units. Okay friends, what I discussed today, this is all about your break-even and the leverage analysis. And at first I would suggest to review the question carefully. It's always good to understand the question first and note the given information, and then follow the process thoroughly. and accordingly you could take decisions. And as per these questions, we have to find the changes in return on assets, which is simply change in EBIT by change in total assets. Since this is the case of all equity finance, we don't have the debt sources. That is why we have used change in EBIT by change in total assets. And that cost of that need to be compared with the cost of capital. If the cost of capital is just 10%, and as you can see here, our return on investment is provide you 21.25%. So it would be good to change the production process. And accordingly, we also calculated degree of operating leverage and the break even point in units as well, friends. And I believe that whatever I discussed today, that would enrich your confidence and understanding level of this question, friends. Thank you all of you for watching this video. If you like this content, please like, subscribe, and also share this channel. Thank you.